Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting and regulatory updates. I'm your host, Ruth Preedy. Joining us today, she's back.
Yay.
It's my podcast twin. It's Avni Mashru. Welcome back.
Thanks for having me.
And you're showing your broad range of technical knowledge. We're on to a new standard. We did leases last time. Today, we're doing business combinations under common control.
And now for something completely different.
Now for something there's no guidance on. Brilliant. So let's start at the beginning. What do we mean by business combinations under common control?
So business combinations, just to take a real step back, so business combinations always involve two parties, so the acquirer and the acquiree. So when you have, and obviously one acquires, this is going more basic, one acquires the other. A business combination under common control is where both the acquirer and the acquiree are both ultimately controlled by the same party. So it's all, I always say, describe it in this way, it's like your left hand and your right hand, basically. Yeah. And you're moving one, from something in that hand. Well, I mean, if you did a clap, that might be a bit squish the whole group.
Okay.
But you've got things sitting in both hands, and you move one from one to the other. So yeah.
Okay, I think I lost the analogy then. Sorry, everyone, for confusing you. Okay, so we're moving things from one hand to another. That's good. And give us some practical examples. Where do you see it in practice?
So the time we'll see this most is often large multinational groups, but really any kind of group where you might have a reorganisation. So typically we see geographic reorganisations and entities being moved around. You'll see it from external acquisitions. So actually true external acquisitions happen. And then as you're trying to integrate the new business into the group, you then might start moving things around the group to then amalgamate things together, put them in the same holding company, all that kind of stuff.
And sometimes we hear the terms, things like hive up,
yes,
hive across, hive
yeah,
down.
So hive up and hive across. So in recent years, I think a lot of groups, and this probably applies around the world, sort of look at their group structures, and there are lots of different legal entities and all sorts of things flying about. And what they tend to do is say, okay, let's rationalise this group structure, almost condense it down into a smaller number of legal entities. And, if I've got 5 different businesses and 5 different legal entities that actually would be best sitting in one place, I might literally just out of that legal entity take or hive up that business into another group entity somewhere in the chain. And I might do that for all 5 entities so that I have 5 businesses in one entity. That's known as a hive up. So I'm literally just hiving out, carving out the business from the legal entity. And then probably what I'll do is just get rid of the legal entity once I'm finished.
Now, if it was just a single asset you were moving around the group,
yep.
I'm guessing we're not talking about that today.
No. So in terms of what is being moved around, that has to meet the definition of a business to be into considering whether there's a business combination under common control. If you're just moving an asset around, then none of this applies at all. So okay. We're not.
Perfect. So we're focusing on businesses today. So we have talked, I can't remember if we personally have talked about, but I'm sure over the years we've been doing this now, talked about business combinations, and they're in IFRS 3. So are we in IFRS 3 territory?
So the reason why we are here today talking about business combinations under common control is the business combinations, as you say, business combination standard, as you say, IFRS 3, has sort of, here's what's covered in the scope of this standard. And one of the things it particularly specifically carves out is business combinations under common control. So we're then left with what do we do now? Because it's not in the scope of IFRS 3. Even though these things are business combinations by definition, the common control piece is what carves it out of IFRS 3.
So we're in accounting limbo. We don't know where we live. Or what happens when we don't know where we live? What can they do?
So when we have a scenario, and this applies across all of IFRS, not just this scenario, but when you come across a scenario where you look at the accounting standards, you say, well, IFRS does not deal with this scenario, what do I do? You go to the accounting policy standard IAS 8, and it tells you have to go and develop an accounting policy using the standards in IFRS as principles to look to, using the framework, but developing something out of the guidance that exists to come up with a policy.
Perfect. So what were the policy choices people look to?
So clearly, we're in a situation where clearly, as we said, IFRS 3 doesn't tell you what to do and you develop a policy. There isn't necessarily one strict way of coming up with a policy. So if we were to look at PwC and the guidance we would say, well, okay, you look at this situation and you look at the guidance in IS8, and realistically, there are two potential options you have here.
Yeah.
One is actually to go to IFRS 3 and say, well, even though technically IFRS 3 scopes out these transactions from the standard, I could still choose to apply the guidance in IFRS 3 to account for my transaction. Equally, I am scoped out of IFRS 3, so my second option would be to use something and this is a sort of PwC term to an extent, does have some groundings in other gaps, but you could use something called predecessor accounting. So, and what that means is that you look at the acquiree, and if you're applying IFRS 3, you would fair value all of the assets and liabilities in the acquiree. Instead of doing that, you would take book values, and I'm simplifying this because it gets a bit more complicated than just taking I say book values. There's a bit more behind that, but you don't have to do a fair value exercise, and you use book values, and the acquirer then uses those book values in order to account for the acquisition. And there's two ways you can do predecessor accounting. You can use the same method, if you like, as IFRS 3. In other words, you can incorporate the acquired business into the acquirer's books from the acquisition date forward, so prospectively. Or you can do it retrospectively, so you can pretend that actually the acquired entity was always part of the acquirer's group, and essentially the acquisition date is not your date for recognising the amount. So you retrospectively go back and adjust your books to recognise the acquired entity.
Okay, perfect. So generally speaking, people either look to the guidance in IFRS 3 or this concept of predecessor, so effectively what your carrying amount was before any of this happened.
Yes.
What you alluded to some of it then anyway, but what are some of the main differences if you're looking at those two approaches?
Yeah, I mean, the biggest difference definitely has to be the fair value exercise. So if you're applying IFRS 3, if you choose to apply IFRS 3, you've got to apply in full. So it's not really an option to cherry pick what you like and what you don't like. Yeah. So that does mean you've got to do a full fair value exercise. There's probably deferred tax implications, or there will be deferred tax implications of that. There'll be all the normal considerations you have for an acquisition down that route.
Yeah.
If you go down the predecessor route, so obviously I alluded to the choice that you have, but using book values means you don't have to do a fair value exercise. It means you don't have to go and find out, what are the values of these assets as of the acquisition date. So that really is sort of the biggest benefit, if you like, but certainly what makes predecessor accounting more attractive.
Yeah, and I suppose the fair value exercise, if you've issued shares or paid more than those fair values, you could have additional goodwill that comes in as well, which you wouldn't have under predecessor.
Exactly that.
So it's a proper IFRS 3 full-on BizCom.
Yeah.
Okay, perfect. And again, probably you've answered the question there, but preferred approach in practice, or does it depend?
Yeah, it does depend. I would say for the ones, if I think back in time to all the questions I've been ever asked on this topic, majority of cases predecessor accounting is what most companies opt for. And if anything, it's because if you think about these, often these are just internal reorganisations, like I said, rationalising group structures, moving things around, to then add on the sort of almost hassle, if you like, of a fair value exercise. A lot of companies prefer to say, okay, let's just do predecessor accounting. It's easier.
Okay. Perfect. So another thing which comes up, we've got a whole chapter about this in the Manual of Accounting, and obviously we talked about this concept of a business combination under common control. But in that chapter we also mentioned there's something different called a reorganisation. Now we've sort of said, well, BizCom is like a reorganisation. So what is the difference? What am I looking out for to decide it's a reorganisation, and then what's the accounting for that?
Yeah, so let's take an example of, and actually in terms of the first flag to look for is in these reorganisation situations, you will always have a new co, so a completely new company that's set up in order to affect this reorganisation. So say you set up this entirely new company and you've got another company, another business, somewhere else in the group that you want to move into the new company. And you affect that by way of a share for share exchange. And it's important to note that a lot of these group reorganisations, the vast majority, will often be affected by way of these share for share exchanges. So now Newco has acquired all the shares in this existing business and sits under this business. When you go and sort of assess just the definition of a business combination, because these are, like we say, still business combinations, or we're assessing whether these are business combinations, IFRS 3 says, well, in the scenario where you've got a share for share exchange, you've got to think whether acquirer, i.e. the party that issued shares, is actually really the acquirer. Because you've got no cash changing hands, and usually for the acquirer, in the scenarios where you've got an acquirer is paying something out, so there's an outflow of resources to acquire a business. And if you work through that sort of the reverse acquisition guidance in kind of determining actually who really is the acquirer, you'll find that, well, Newco actually doesn't really have much substance to it, isn't much going on, and actually the acquiree, the accounting acquiree's existing business, actually is the acquirer. To have a business combination, you need to have two businesses coming together where one acquires the other. You've now got Newco, which hasn't got a lot going on in it, not a business.
Yeah.
And you've got existing business sitting down below that is a business. I can't have a business combination if I don't have two businesses coming together. So I've now actually failed the definition of business combination altogether.
Okay.
So the key way to remember this is, in order to have a business combination under common control, there needs to be a business combination.
Yeah.
If you don't have a business combination, you've lost that piece of it. And you say, well, what am I left with? Well, actually, really, effectively, it's just a capital reorganisation. And a capital reorganisation is literally saying, well, nothing's really changed with the business that I moved to under the Newco. All that's happened is I've just put a new company on top. But all that's done is changed a bit of the capital structure, but not changed anything at all in terms of it combining with another business. It's not combined with another business at all. It's still the same as it was before. So it's always important to look at the before and after and say, okay, for the business that's kind of moved and been acquired, combining it with the acquiring entity, has that actually changed anything? And if the acquiring entity is a Newco, the answer is probably no. If the acquiring entity has actually got some substance to it and has a business in there, you go, well, actually, yes, something has changed. I'm now sitting under another business.
Yeah. So if we do decide that we don't meet the definition of this under common control and it's a reorganisation, then what do we do for accounting?
So then what you do, in drawing up the consolidated accounts of the Newco, because that's really where this all has an impact, is you basically have a situation where you pretend as if everything is the same as before. So like I said, before and after, nothing's changed.
Yeah.
So the consolidated accounts of the Newco are just going to present the results of the underlying business as was, retrospectively. So there's no choice here. Okay. You're saying in substance, nothing has changed. Nothing has changed at all for this company. I have just slapped on top a Newco, but other than that, nothing's changed. Those consolidated accounts would look exactly the same as any, say, consolidated accounts that existing business would have prepared before this all would have happened.
I feel like this podcast, we need a moving whiteboard that we can draw
we
pictures.
Do,
It's
yeah.
really hard to explain common control.
It is.
We're waving our hat, or
I know,
everybody's waving our
waving.
hands around. But I'm like, I'd always be drawing a picture of a group structure and saying like, this is going here. So it's difficult to do just in voice. But key thing there, so it is I do find this area of accounting funny because you're sort of saying, one, do I meet the definition of a business combination?
Yes.
So I have to look into IFRS 3 to work out, is there a business? And do I meet the definition of BizCom?
Yeah.
And then when you do, it's like, oh yeah, but it's a business combination of common control, so you're not in 3 anyway.
Yes.
And then,
yes.
So it is a bit of a loopy.
It's a bit of a loopy one. And this one is slightly different in that IFRS 3 is the only standard that defines a business combination. So let's put aside the under common control bit.
Yeah.
You still end up having to go in there to go, actually, if I got something that is in the scope, that even fits in the standard at all.
Yeah.
And what we're saying is that when you don't have a business combination, forget the scope out, but you don't even get into the door of IFRS 3 because you don't have something that meets the definition of business combination.
Okay, so a bit of a loopy one, but very helpful to talk about the two there. So coming on to the last question, so we talked about there's no clear guidance. It's not clear if there's no standard it fits into. So when we usually have this, the ISB looks into it. So what's going on at the ISB?
So this question has been rumbling for quite some time. The ISB, obviously clearly has been aware of the scope exclusion, has received many requests over the years of how do we deal with this. They do have a research project ongoing around business combinations under common control. As you can imagine, it's quite a tricky area.
Yeah.
To figure out actually what is the best way to deal with the accounting here. Current estimates are a sort of discussion paper is perhaps expected next year, so 2020.
Okay.
First half of the year, so still a little way off.
So we're going to need a few more podcasts. We're going to have you back in 2020.
Yeah, I think so.
Okay, perfect. Okay, but if you do obviously want an update on the research project, that's on the ISB's website. And like I mentioned earlier, we do have some manual of accounting guidance with some helpful example with the group structures. So if you haven't followed anything me and Abby are talking about,
I would highly recommend, and obviously shameless plug for our manual of accounting, but I would highly recommend taking a look at that. And like Ruth, you say, there is a handy table actually that sort of contrasts all the different business combination, predecessor accounting, capital reorganisation, that again hopefully helps.
I use it lots. And don't forget to disclose.
Absolutely, always the best thing to do.
Okay, perfect. We've come to the end of our 20 minutes, Abney. Thank you very much for coming back and talking about another topic. Your brain is so big. So today we covered common control. Hopefully we've given you some good tips of where to find guidance. I'm your host, Ruth Prudy. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.